Ruh-roh, Raggy, we have a serious problem.
And no, I'm not talking about the fact that we're not even 2 weeks into the new year and I've already probably lost more than 5 different chapsticks. I'm talking about the fact that the world is both literally and figuratively on fire. As I'm filming this, the situation in Los Angeles is obviously beyond heartbreaking. And if you bring your attention to both the economy and the stock market, well, that's also a dumpster fire. In this video, I want to break down exactly what's going on in the world's largest casino and why the trend since the start of the year until now has been down and down and down. It seemed to accelerate this most recent Friday. And really, I want to point out certain trends and seasonality and different data points of why I think there's a bit more pain for us to survive. So with that all being said, if you enjoy these type of market breakdown, let me know by hitting the like button. Don't forget to subscribe. And with that being said, let's get into it. Well, folks, it was a bloody Friday. Dow tumbles nearly 700 points Friday as strong jobs number report casts doubt over Fed's rate cut path. That sounds like a little bit of a paradox, right? We got a good economic report, yet the market decided to vomit. That's what I want to talk about, why this seemingly good news was actually not so good for the old stock market. US payrolls grew by 256,000 in December, much more than expected, and unemployment, in fact, it fell to 4.1%. Now, I get it. On the surface level, that actually sounds good, but as the stock market's about to tell you, it was not good. The SPY dropped 1.5%. The Qs dropped 1.6%. The small cap sector dropped in excess of 2.2%. So clearly the bears were in control, and I get it. It's confusing because we got seemingly good news. Before we get into that, I do think it's important for us to understand that it all started on Wednesday, December 18th. Yes, the pain we are feeling right now started about a month ago. And for those of you who need a quick recap of what happened on this absolutely dramatic sell-off of a day when we dropped almost 3%, that's when Jerome Powell, the chairman of the Fed, aka Daddy Powell, came up to his press conference and said, hey folks, we actually think that we might not be giving you as many rate cuts as we told you we were going to. And the reason for this is inflation doesn't really seem to be coming down and the economy's not that weak. So we think it can withstand the fact that we don't cut these rates. So that was the TLDR of this meeting, and the market clearly did not react well. Since then, we have lower highs, we have lower lows, and we just cracked these lows recently, at least at the point that I'm filming this. And the reason we're going down even more is because we just got that important data report, the jobs number and the unemployment, that said, oh, the economy is kind of strong, which means theoretically the fact that the economy is strong on a relative base. And then also the fact that inflation has been coming up ever since September. Why would the Fed cut right now? Because we know their job is clearly to fight inflation. And if you look at the other major indices, this has been the trend ever since that dramatic drop off in mid-December. So what we're seeing now, this continuation to the downside, it really all got going in mid-December. And as I alluded to in the intro, I think things are about to get a little bit worse, but we're seeing it in the SPY, we're seeing it in the Qs, and we're seeing it in small cap. So there's a problem, but let's really get into this. I very much want you to understand this entire debacle. Strong US job numbers report backs case for pause in Fed rate cuts. That's it. It's the fact that we're probably not going to be getting a rate cut anytime soon. I wouldn't be holding my breath on it. Currently, the Fed fund rate is at 4.25%. And as I'm talking about all of this with you, there's a 97% chance that we do not get an additional rate cut in the January 29th FOMC meeting. So this is the first thing you have to consider. And you might be thinking, okay, hang on, I'm not really getting it. The fact that we're not getting these rate cuts, why is that so bad? Well, it's right here. If you look at the 2-year, which we know the Fed has the most influence over, the 2-year yield is ripping, and also the 10-year yield is ripping. When you see yields ripping, that makes money itself more expensive, as in it's more difficult, it's more costly to borrow money. If companies and individuals are not borrowing money, obviously down the river, you're going to have a negative impact on growth and the economy. So that's very high level. Of course, there's many different aspects to it, but that's the major takeaway you need to know in this one. I should also point out that if you look at the yield curve, which is the 10-year yield minus the 2-year yield, you're going to see that, yes, we are no longer inverted, we're above the zero line, and we're going up. This is referred to as bullish steepening. And remember, every time historically, we've seen this rip from the negative to the positive territory. Well, if you give it enough time, it has not been a good news bear situation for the overall unemployment situation. In fact, as this shoots up, we've seen, especially in soft labor market situations, that unemployment also goes up. So that's a little bit more down the line, but I just wanted to, since we're talking about yields and bonds, really the problem here. I hope that makes sense. The major thing you need to know about not only mid-December, but also what we just saw on Friday, the unemployment report, was the Fed is not so aggressively cutting rates. They're not so aggressively cutting rates because from September until now, inflation's been going up and up and up. And one way to fight inflation is actually not only to keep rates where they are, but to raise them. So the Fed actually might be potentially thinking about jacking rates up. And when they do that, guess what? Money itself becomes more expensive, and then you have less growth. And then obviously that's not going to be good for all the equities within the stock market. That's the first thing you need to know, but it gets even more complicated. Let me bring your attention to seasonality. You're going to notice here that over the past 20 to 30 years, mid-January historically favors the bears. And when you dive into the last 5 years, you're going to realize the upcoming week, the third trading week of January, is the fourth worst week of the entire year. Obviously, it gets really bad, and then there's other little juts to the downside, clearly favoring the bears. But the week we're about to enter into, I hope you're watching this video in real time, because the week we're about to get into, the third trading week of the year, is the fourth worst week of the entire year. So seasonality isn't so good. And what if I were to tell you that we have a whole slew of massively important reports, such as inflation, PPI report coming out Tuesday, CPI report coming out Wednesday. Those are both inflation reports, producer price index, consumer price index. And remember, the whole situation of why we're where we are is because of the Fed's concern about inflation going up. And or if these numbers come in hot, as in if they come in high, well, not only is the Fed clearly going to stay where they're at, we have to have that serious conversation of, are they going to jack up interest rates once again? Which, remember, the whole theme in this video is money's about to become more expensive. Later on this week, we also have retail sales, and then we get the CPI report on Friday, January 17th. The other thing I should tell you about January 17th, it's OPEX. So there's a ton of options expiring, and that's going to be a lot of volatility in the system, deciding what they do or don't want to do. Then we head into the weekend, where we're going to find out about TikTok, more on that in a second. And then right after, on Monday, we have the inauguration, brand new president. Who knows what's going to come with that? So you can tell that there's a lot of uncertainty in the system, and clearly the market doesn't like it. This is what the market did, the S&P 500, but also the options market on Friday. Shout out to Spot Gamma for giving us this data. On the left side, that's the price of the S&P 500, the actual SPX index. That's the white line. And then you're going to notice on the right side, we have the delta notional. For those of you who need a quick recap, this is a measure of the bullishness or bearishness, really, of the options market overlaid on top of the stock market. And as you could see from the green line and also from the colored kind of purple red line, we were down and down and down, telling you options were not happy. Now we can get a more detailed look. You can see that people were not really touching calls whatsoever, but they were actively buying protection. They were going long on puts. So obviously this is a derivatives market that is becoming more and more important, but it's telling you that people are buying protection. They are not happy. And just to add a little bit of sprinkles onto this little fun cake we're baking up right now, we're about to get into earnings season. So this upcoming week, Wednesday, you have all these financial plays, JP Morgan, Citi, BlackRock, Wells Fargo, Goldman Sachs. If they miss, that could be a huge problem. Later on, we have TSMC, United Health Group, Bank of America, Morgan Stanley, PNC, and this is just the start of it for the next 4 to 5 weeks, where it's going to be earnings, earnings, earnings. Speaking of individual companies, TikTok ban likely to be upheld by Supreme Court, putting pressure on Trump. Ahead of the looming ban, TikTok creators ask fans to find them on Instagram or YouTube. And is it completely bad news? Not necessarily. Billionaire Frank McCourt, Project Liberty, bids for TikTok ahead of the Supreme Court arguments. So I know this isn't directly impacting the market, but it could have down the line impact on US-China relations, especially with the new president coming in. So I just wanted to put this on your radar. But right now, we are in a very, very frothy time. Once again, coming back to the SPY, the ETF tracking the S&P 500, ever since about the start of December, lower highs, lower lows. We just cracked this recent low. Yes, there is a downside gap fill to 576.74, but we are under serious monetary policy pressure. Right now, the Fed clearly is not being incentivized to lower the yield because they're looking at inflation, which, as I said, has been coming up ever since September. And then all of a sudden, when you get the fact that maybe the economy can take it because unemployment is lower than expected, we're adding more jobs than expected, that, if anything, might entice the Fed to jack up the Fed fund rate even more, once again, to fight inflation. It's the concept of like taking painful medicine now so the disease later on isn't that much worse. So with that being said, yes, I noticed that there's this downside gap fill on the SPY to 576.74. On the Qs, there's one all the way down to just below 493. And then on the Russell, there's one all the way down to just below 213. So I'm paying attention to that. But I also want to let you know that on a little bit more of a push to the downside, we might be seeing or experiencing a thing referred to as a Vanna rally. And that's basically when you have a bunch of people in puts and then all of a sudden they have to close it. And I don't want to get too nuanced and nerdy on you here, but there is a chance that if a ton of people are in puts, then they decide to get out, you start to see a pop back to the upside. In that situation, I want to be explicitly clear on this. If we start to see a little bit of a pop back, I think that's going to be a classic bull trap. I will be looking for, in the very short term, a bit of a sell-off, followed by a bounce up to a trend line, maybe the 50 EMA, maybe just this EMA cloud in general. And then in the February to March timeframe, I'm expecting from peak to trough about a 10% pullback. Once again, these are just my own thoughts and opinions of where I see things going in the short to medium term. But right now, the action in the options market, what we're seeing out of the Fed, and just some concerning numbers overall, I don't think that this is the time to be the hero and buy the dip. Obviously, those are my thoughts, so I'd love to get your thoughts in a comment below. And also, if you want me to give you an update on an individual equity and my thoughts there, let me know in a comment, and I'm more than happy to include that in future just market recap videos. I appreciate your time. I'll catch you in the next one.